What are the different implied volatility calculation methods? If you have ever wondered how traders determine the expected volatility of an option, you are in the right place. Implied volatility is a key concept in options trading, reflecting market expectations about future price movements. However, it is not something that can be observed directly. Instead, it must be calculated using various methods. Let's break down the most common calculation methods for implied volatility. The first method is back-solving using option pricing models, particularly the Black-Scholes model. This model requires several inputs, including the current market price of the option, the current price of the underlying stock, the option's strike price, time remaining until expiration, the risk-free interest rate, and any applicable dividend yield. Since implied volatility is not known, traders input the observed market price into the model and solve backward for the volatility value that makes the theoretical option price match the market price. This often involves an iterative search process, adjusting the volatility input until the modeled price aligns with the market price. Next, we have iterative numerical methods, which include trial and error or root-finding algorithms. Because the Black-Scholes formula does not provide a direct way to find implied volatility, traders use numerical methods. This involves guessing a volatility value, calculating the option price, and comparing it to the market price. If the calculated price is too low, the guess is adjusted upward, and vice versa. This process continues until the difference between the calculated and market prices is minimized. More advanced techniques like Newton-Raphson or bisection methods can speed up this process. Another useful tool is the Implied Volatility Rank, or Roman IV rank. This method assesses whether the current implied volatility is high or low compared to its historical range, typically over the past year. The Roman IV rank is calculated by taking the current implied volatility, subtracting the 52-week low, and dividing that by the difference between the 52-week high and low. This ratio helps traders understand the relative level of implied volatility, which can influence their trading decisions. A high Roman IV rank indicates that options are relatively expensive, while a low Roman IV rank suggests they are cheaper. Lastly, while the Black-Scholes model is the most widely used, there are other models like the Binomial model or stochastic volatility models. These can also be used to calculate implied volatility, especially for American options or in situations where the assumptions of the Black-Scholes model do not hold perfectly. These models similarly use market prices and input parameters to derive implied volatility. In practical terms, traders use implied volatility to gauge market sentiment and the expected magnitude of price movements without predicting the direction. High implied volatility typically increases option premiums, benefiting option sellers, while low implied volatility decreases premiums, favoring buyers. Understanding how to calculate implied volatility is essential for options pricing, risk management, and strategy selection. By knowing when to enter or exit positions based on volatility expectations, traders can make more informed decisions.